All right. I think we are live. This is the Investing Power Hour number 85. My name is Brett Schaefer. I'm joined as always by Ryan Henderson and special guest host of the new J Row show, which I see he has another guest there
This
for
is
any of the
Leo.
YouTube watchers. Yeah, it is
Yeah.
John Rotanti. John, how are you doing today? And I guess how is Leo?
Uh, hey, Ryan and Brett, always glad to be on with y'all. Leo is great. Um, so my girlfriend and I are living in Missoula, Montana, just for the three last months of this year, just having some fun up in Montana. And the Airbnb that we're renting has a dog door. And so we've opened that and just Leo gets to go out whenever he wants and like explore and hunt. And he has brought in a live bird and a live mouse. So he keeps it interesting.
Hey, that's Montana for you. Yeah.
Yeah,
All right.
exactly.
Well, as I did say, you have just started the J Row show. And it's been three episodes. One of them just came out today. For anyone
Yeah.
that doesn't know, who's listening on Sundays, we do these live every Thursday morning. So, how has the experience been? And it's kind of interesting because you kind of have the idea when you start the show, you're like, all right, it's going to be like this, but then when you get into it, things evolve. So, how is it going?
I've I'm loving it. I'm grateful to everyone that is listening and supporting me through it. Grateful to you guys for editing it and doing all of the back end stuff on it as well. Yeah, so we dropped the third episode today with Quoc Tran. The entire premise of the podcast is to study processes and frameworks and mindsets that people put in place to maintain winning performance. And Quack just wraps himself in process. And so I think the third episode is good because it's shorter than my first two. It's not even an hour. And, Quack's got three bucket of stocks that he invests in. And he's got a three-stage research process. And he's got three layers of risk management. And he just added in the last few years two process improvements. And every year they do an annual moat trajectory review on all of their holdings and all of their watch lists companies. And then every year they also do they dig through any sectors or industries that just got smashed to see if they can find any hidden gems. And so everything he does is about like process and stages and layers.
Nice.
I
And
like that. I like that
oh, go
idea
ahead,
of
Ryan.
just going rummling through the garbage or rummling through whatever got destroyed from the year before.
Yeah,
I guess we're going to talk about some of the news from the week, but before we get to it, I want to ask a couple more questions about you and your show.
please.
For anyone that's listening right now who hasn't listened to your show, maybe give a little bit of an explainer on what it is and who your target audience is.
So as I said, I'm trying to explore the processes, frameworks, guardrails, structures, and mindsets masters put in place, what it takes to achieve mastery. And because I'm an investor, um, most of the episodes will be focused on investing. As far as target audiences, I can think of maybe three groups. One is allocators. So RIAs, financial planners, certified financial planners, wealth advisors, stockbrokers, anyone that is putting their clients into mutual funds or separately managed accounts. I am trying to pull back the curtains as far and wide as I can on what the internal investing processes look like at these firms. And I think through the first three episodes, we've done that. We've achieved that. Um, a second audience would be investors that have an investing firm, founders that have an investing firm or that are thinking about starting an investing firm that are looking for best practices to implement. Either they're looking to start a firm or they currently already own a firm and run a firm, but they're looking to level up and put better processes in place. And then the third audience would be analysts looking to get a job. at some of these buy side firms and what it's like to work day in and day out with Bill Nygren at Harris Associates at Oakmark, with Dan O'Keefe on the Artisan Partners Global Value Team, or with Quoc Tran at Tran Capital, which is a boutique based out of San Francisco. Like, what's it like to work with these master investors day in and day out?
I gotta say, I was the way we do this is Brett or Brady does a lot of the editing, so sometimes Brett and I get to hear it for the first time when it actually goes live and gets published. And if you are like an analyst and you're aspiring to join a fund, I cannot, especially the Bill Nygren one, because I haven't gotten through the whole Dan O'Keefe one, but you got to listen to that because he goes through basically literally your daily tasks of what your job will be and how to do it well. And if you're thinking about applying to anything like that, just I can't express it enough. That's a must listen.
Yeah,
that's
and
what
here's
I'm going for.
Yeah, exactly. And for anyone, we know our audience falls into that bucket as well, and we don't do this type of stuff. So we know that our audience would love that. One more question: what is kind of the next plans for the shows? You're going to launch this, man, a little over a month or so. What are the next plans maybe for 2024, or maybe just the next few months?
You know, I've got 3 interviews lined up, and I'll just say that all 3, like, I'm so excited for these. Like, I don't want to give away 2 of the names. One I'll give away. So I am going to be interviewing Todd Alston, who is Chief Investment Officer at Parnassus Investments. Parnassus is the largest pure play, like, sustainability or ESG mutual fund in the US. Todd is also, he's a 5-star manager, according to Morningstar, but he's also on the Barron's Roundtable. And the reason I mentioned Todd is because a couple weeks ago, I posted on X an article, a research report that he published on the semiconductor manufacturing cycle, you know, where we are in the current cycle. And he started off as a semiconductor analyst. He has lived through 8 semiconductor cycles. This guy gets it. And that post, for me, went viral. Like, based on my metrics on X, it went viral. It had like 300 likes and 50 reposts in like less than a day. And for me, that is a lot. And so I promised my Twitter followers that I would get him to come on the show, and he has agreed to come on the show. But, you know, the 2 others that I have lined up are, you know, top respected, revered, admired investors on the planet today.
All right, that's a perfect tease. And again, that is the J Rowe Show. Go check that out. I'm excited to listen to the one that came out this morning. Get it wherever you get your podcast. Okay, let's hit some of the topics. Ryan, you put a lot in here, so maybe, I don't know, Ryan, you choose. Or you choose. What do you want at first?
Well, I want to get this one out of the way because it's a little bittersweet. The Buffett trading scandal. Did you guys read about this at all when it came out? I'm getting some nods from John here.
Yeah, I did. I read the ProPublica article.
Okay. Well, I'll kind of go through it and maybe we can give some thoughts on it. But there was an article from ProPublica that basically highlights, you know, Buffett he's been very open about the fact that he has a personal account that's run separately from his, you know, any Berkshire trading activities. And he's always kind of said that there'd be a conflict of interest if we were trading the same stocks. And so this ProPublica article says on at least 3 occasions, Buffett has traded in stocks in his personal account in the same quarter or the quarter before Berkshire bought or sold shares of the same company. It's kind of interesting because he was oftentimes going against what he was saying in public. So, and he sometimes even going against what Berkshire itself was doing. So, in, I believe it was 2009, he did an interview with Fortune kind of praising Wells Fargo. And, you know, this had a huge impact on Wells Fargo. It seemed, at least, like the shares jumped 13%. People assume that a lot of that had to do with Buffett's praise for the company. But he privately, that same day that he did the interview, sold $20 million worth of Wells Fargo shares. Now, I'll save any of my own personal takes for the end here. The second occasion was, it says over several days he sold $35 million worth of Johnson & Johnson shares. At that point, Berkshire had effectively revealed that it too had sold Johnson & Johnson shares. That's the one that kind of concerns me a bit. And then the last one here, it says in August 2009, Buffett appeared to move in his personal portfolio in the opposite direction of Berkshire's portfolio. He sold $25 million worth of Walmart stock in his personal account, even as Berkshire almost doubled its stake. Now, with the Wells Fargo and the Walmart one, I kind of think he doesn't want to seem like he has a conflict of interest, so he's getting rid of them in his personal account. Now, I bet he might touch on this at the meeting this year and say, like, just give full disclosure on everything that happened. But the only one that kind of concerns me is selling out kind of the same quarter that he sold out of Johnson & Johnson. What did you guys make of this? Does it feel newsworthy? Is it any tarnish on his reputation for you?
I think it was the article also implies that he may have violated Berkshire Hathaway's own internal rules around ethics and trading. If it turns out that's the case, that he violated the own rules that he wrote, I think it shouldn't have been done. I think it was a lapse of judgment in the very least. And the amounts are so inconsequential relative to his net worth of $100 billion. At the time of these trades, maybe his net worth was less than that, but 50, 60, 70, 80 billion dollars. It seems inconsequential. Like, why even do it for $20 million here, $20 million there, when you're worth that much money? It could be just a lapse of judgment. It could be, like a brain fart on some level. It could be more than that. He hasn't spoken out about it. He hasn't denied it. You can't really deny it. I guess we got to wait until the meeting and to hear something, like you said.
Yeah, and I would last year it was either last year or the year before, there were accusations about him potentially insider trading with Activision Blizzard because of his close relationships with Bill Gates and Microsoft. He shut
that down though, right?
Yeah, and he
that one didn't make any sense.
He pieced through every part of it and said, here's exactly what happened. Here's how I traded. Here's exactly when we bought, why we bought, that kind of thing. I would hopefully like to think that he'll do the same thing at this meeting and just describe kind of what his actual thought process was behind the actions, because obviously the way ProPublica made it sound feels a little more malicious, but it doesn't. I'll let Brett talk here in a second, but it doesn't make a whole lot of sense just in the fact that, like you said, it's so inconsequential to his own wealth, and what he does in Berkshire's portfolio ultimately matters so much more on his net worth
and to his legacy.
Yeah. I'd say one, he might talk about it in the shareholder letter, possibly, which is before the annual meeting. Some of these don't look great. I can't remember which one he had here, Ryan, but there's one that could maybe be explained, like he bought in his personal account and then later they bought. Like, that's not the end of I don't think that's the end of the world, but the one where you sell before Berkshire sells, I think, or I don't know. Some of these do look like, if it is how ProPublica outlined it, it's exactly what happened. I don't know if there's a good explanation there, because I would note that they fired one of their longtime lieutenants. What is his name?
David Sokol.
Whoever it was like in 2011 for buying Lubrizol before they announced an acquisition of some sort related to that was going to boost the stock price. That's clear cut. That's violating probably every company. You have a rule against that. That's maybe I'd say definitely worse than this, but this is close to that if there's really no explanation here. And could it be coincidental? Yes, but I don't like that someone like Buffett has a personal account like this. Yeah, like you're allowed to have it, but if you're someone with his stature, his legacy, his whatever, I'd rather have everything just be in Berkshire, especially because they have the investments there as well. I also didn't like, while the track record was incredible, when they had that story of one of the lieutenants today, Combs or Weschler, I forget who, has the $200 million plus Roth IRA where they just crushed it over the last 30 years. Yeah, that's great. But hey, look, why don't we put those, how much time are you focusing on your Roth IRA? How much time are you focusing on Berkshire Hathaway? That's kind of how I think of it. Will it tarnish his legacy? I don't know. I guess we'd have to see. But clearly, if someone in the company did this, I think it's possible they would get fired. If one of his lieutenants did this exact thing.
At the time of some of these trades, there may have been someone else. Sokol might have been the one getting in and out of stuff too, right? Because he was managing some money for them at the time. So it's possible that it wasn't Buffett specifically, but it should have been communicated. The ones where I think like, who really cares is if they're buying a big stake in, okay, so they doubled their position in Walmart. If he sells out of his own measly little personal stake in his own account, I kind of think like, who cares? It seems like he was trying to get rid of it so there wasn't a conflict of interest. But it's the ones where he buys and then they buy, because he knows that if they buy something, the price will probably go up.
Yeah,
for the most part. If it's like a small position, I don't think anyone really cares. But that actually, I think, maybe leads us into the next question, which is Buffett filed his 13F. Did you guys take a look?
13F season. Gotta love that.
There was some Liberty. They bought some Liberty positions. And then the other one, the big one, which I thought was absolutely hilarious, was they asked to file one of their positions confidentially. And everyone is just like, it could be my largest holding, it could be.
It's probably the stock.
It might be Palantir or Tesla. And I'm like, I just kind of doubt it. But the any thoughts on what the mystery stock could be, or maybe better question, why they chose to file confidentially?
I think they filed confidentially because they're still buying.
Yeah. Well, it has to be a big stock. It has to be a large stock then, right? It has to be.
Look, I play this game every time Buffett has a mystery stock, and I've been wrong every time. But to play, Schwab comes to mind. Huge brand, asset gathering machine. And, depending on what you come up with for normalized earnings, maybe trading at 10 times, 11, 12 times normalized earnings for a brand that doesn't seem to go away. It's consumer facing, things Buffett tends to like. Disney is another one that comes to mind. Once again, consumer facing brand, in that sort of used to be kind of blue chip stapley name, down to 80. It was 80 recently, per dollars per share. There's some activist investors there where Buffett doesn't have a history with, but he has sort of bought after the activists have done their work. For example, Peltz was involved with Heinz years ago, and then Buffett bought Heinz in a partnership with 3G, I think it was, or something. So, Disney comes to mind, Schwab comes to mind. Those are the two that come to mind for me.
Brett, what's your pick?
I would say either financials or energy makes sense to me. It seems to be what they are targeting right now. And with financials getting beaten down, I'd say that makes a lot of sense to have Schwab. So maybe it's one of the banks that they sold out of. It wouldn't be Bank of America. I don't know. Let's say one of the energy companies. They have
those are all
what is it? Exxon.
Right?
Yeah, it could be one of the energy stocks they don't own, but yeah, I guess it might not make as much sense because they already own Chevron and Occidental. I'd go financials. Maybe it's JP Morgan or something like that. I don't actually know what those stocks are trading at, but what are the large financials that could have been beaten down Like Schwab makes a lot of sense that as kind of one of those, and they already own Bank of America, so maybe I'd say JP Morgan then if it's one of those.
Could be Nelnet. Could be my largest holdings.
Yeah, our largest holdings. Yeah. All right, let's hit I want to hit or Ryan, do you have anything else on that?
No, I honestly have no idea. I always think it's funny how everyone speculates when that stuff happens, but I bet it's something that everyone will be underwhelmed with. They'll be like, oh, okay. Like when he took a stake in HP or whatever it was, everyone's like,
yeah,
all right, not following you into that one, but all right.
Yeah, definitely. Yeah, that's do not just follow Buffett. He makes mistakes sometimes, and you're not going to know when he sells or buys. So
absolutely.
I want to hit this topic, though. I think is my favorite one of the week, and it is the updated information we got on maybe I'll call it the Google, Apple, Microsoft kind of big tech search trial. And this week we had a lot of stuff on the Apple Google distribution deal. Did you guys follow this at all? Some of the information that came out there? Yeah, I mean, maybe before I guess the big revelation was that Google pays Apple 36% of Safari search revenue. And that was not supposed to be disclosed, but someone accidentally said it while on the stand. So now it's public information. Curious, maybe John, you go first. You said you've been following this. Curious your thoughts here and what it means for some of these companies, because it's a lot of money that could change and go to different pockets now.
I mean, I just read the headline. It was a shockingly large number. That's a lot of, that's a lot. That's more than a third. I find that like regulators start to pay attention at a third. Like when companies get a third of an industry, 30% of the market share in an industry, something like that. It's just kind of a number that jumps off the page that can get people talking. I'm not saying regulators going to look at this, try to redistribute some of this money some kind of way, but it's a big number. I think we all assumed it was going to be large, but not that large.
Wait, so this was of Safari's revenue, 36% comes strictly from Google?
No. Google's search revenue that I believe
36% of their search revenue comes from Safari.
They pay, like I wouldn't call it blackmail. They don't call it blackmail, but or the bribe or whatever you call it, the deal that they have. Google pays Apple apparently 36% of the revenue they earn on Google search on the Safari browser or whatever you call it.
I don't know.
It's quite interesting.
I don't know if it's quite interesting. Like if you're just thinking about how much of Google's revenue probably comes from mobile.
Mm-hmm.
And
I think Safari's got to be their number one. I mean, iPhone users are the most valuable.
You don't think Chrome on the desktop is larger?
Oh, from a money-making perspective, I'd say it's probably Safari because, I mean, look, it's predominantly the wealthier countries, Japan, US, Canada, Western Europe, China, or maybe China, I guess, exclude China. Google's not there. And then also, I mean, the most searches from mobile these days. So I think it's going to be quite valuable.
I gotta say, as a Safari user, I think I'd be bummed if my default search engine switched to Bing or anything else.
Something else.
DuckDuckGo. I think I'd be.
Well, just download. I think a lot of people would end up downloading Chrome, which is kind of what I did because I just like to have all the Google logins saved way more seamlessly on an Apple device. Here's what my take is here is, and I'm curious if you guys agree or disagree. I think with this lawsuit, some more stuff could come out. So with the information we have today, I think there is not that much risk to Google / Alphabet from a investing perspective, financial perspective, losing profits. But I think there is a lot of risk for Apple. What do you guys think?
I think Apple tends to get the pass from regulators. Always. I don't know why, but they do.
Are you suggesting risk that Google stops paying this in some sort of way?
That they're required to not do the...
Yeah.
I call it the bribe, but because I think in that situation, Google, yeah, okay, there could be some uncertainty of market share in search. But if Apple is required to not take bribes here, they can't just say, oh, well, we're not going to take it from Google. We're going to take it from someone else. The only one that has the money to do it would be Microsoft. It doesn't make, like, I would be concerned because what is this, 20% of their overall earnings? I mean, if that goes away, it's not coming back. And how much would they have to grow to get that back? It would be 5-6 years, maybe even longer to grow and
20%
to retain them.
of
Probably, yeah.
Apple's earnings.
I mean, they earn like 100 billion or so. So
it's probably what, half of the services revenue segment almost. No, a little
and
less.
Almost all the profits, I would say.
I don't know. Any thoughts, John?
It seems, I mean, it's, I own both of these. And I'm probably not. So the question I always ask myself when news comes out is, what do you do with it? Right. And, I'm definitely not doing anything with my alphabet position, which is a top 5 position for me. And I don't think I'll do anything here. I don't think I'll do anything with Apple because of this news. I've been considering trimming my Apple position, but before this, like, it's, almost 2.8 trillion. It's not growing as fast as the other mega cap tech names are, and it's trading at, I don't know what it is, 30 times earnings or something like that. I'm not saying it's a sellout, but I've been considering trimming my position for that reason. So I'm not sure this news specifically is trade worthy for me personally.
I wonder how many people, how many Apple shareholders just continue to hold because they just don't want to take the massive tax hit and they've been shareholders for a long time. Because I don't know a lot of people that are starting Apple positions today.
No one sells it though. I mean, the indexes, Buffett's going to be staying there. He says it's a never sell for him. I mean, where is the sell? Like, it's hard to see how it comes down unless something material. Like, I think if the worst case scenario in this situation where they lose all this money every year happens, yeah, the stock would go down. But if it just remains the status quo, it's kind of hard to see how that happens. But I think it's a fascinating trial. You add in the Microsoft stuff as well. I mean, these are the biggest companies in the world, some of those powerful institutions in the world, and we might see a big shakeup here. But also, sometimes there's a lot of noise in the regulation and the antitrust stuff, and nothing actually happens.
I agree, Brad. I think what makes it most fascinating to me is just taking this trial out for a second and the revelations that came from this trial out for a second. It's the dominance of a handful of companies and how it's driving returns right now. The S&P is up, I don't know, it's at 16 or 18% this year, but the equal weight is up 2% this year. That's a big delta. That's a big, big, big delta. And, I think that since I've been on, Twitter, now X, I've made 2 sort of like high level calls that have been great. 2 in 2.5 years. One was when home builders were trading at 4 times earnings and a discount to liquidation value. I tweeted 24 times that I thought home builders were the place to be, and all of them were up 100%. So that's one. It was a great call at a like high industry level, sector level, almost macro level. The other was November of 2021. I tweeted out, I think the single most important question investors need to ask themselves, the single most important question is how I worded it, is will mega cap tech maintain its dominance? Turns out that's pretty much the most important question, because 7, 8, or 9 or 10 names have dominated the market returns, the large market returns. That's a pretty good call. And now when I made that call in November 2021, mega cap tech was near a peak. And then it kind of fell for a while. Amazon crashed, Google crashed a bit, but now they're at basically they've recovered and then some. So now I think it's another time to be asking, is mega cap tech going to maintain their dominance, or are these small caps that have just massively underperformed going to pick up some of the slack? Now,
yes,
if we go into a recession, this is an if, small caps for a period of time may struggle even more because they don't have, 50 billion in net cash on the balance sheet. They don't have high enough credit ratings, and so it's going to be more expensive for them to borrow. They don't have multiple lines of business across product lines and geographies. They're just a little more risky. But if you look out 5-7 years, do small caps take the torch again? I don't have an answer necessarily, but I think it's an important question investors need to be asking themselves.
Yeah, it's a big unknown. And I think another thing to ask, and I know this is something that is very hard to have a take on, or it's still to be determined. Like, some people argue really strongly for the impact of index funds. Some people say that it's vastly overrated. I think you got to ask, okay, if index funds continue to take market share, how do these stocks, like, where is the selling pressure going to come from? And maybe that's just something you say when they're, at the top. But yeah, that's a big question. I don't know. Like, right now, I don't know any big tech. Part of it's because we're kind of transferring some funds around at the moment, but it's a tough bet to make to have no mega cap tech exposure.
If you want to keep up with the index, it's very tough.
Yeah, if you care about that, yeah.
Yeah,
exactly.
If that's something that you get paid to do, it's a very tough decision.
I also think, from a competitive standpoint, and I bet they've said this every time companies have become massive conglomerates or massive businesses, probably said this in the 80s, the 90s, but I look at the companies today and I think, from a competitive standpoint, how on earth do you compete with them? Because you take a business like cloud, and Google has been able to throw, well, I guess they were kind of maybe early to it, but they've been able to lose and hemorrhage money for like 10 years before getting to profitability and scale. Other companies just can't afford that. So it's really, they have kind of the unlimited resources and the willingness to go after a lot of those opportunities. We do have a ton of questions in the chat, so I feel like we should get to some of these. Brett, do you want to take any of these here?
Sure. Yeah. We got one from John first. Says, awesome guest. Nice to see you, J-Ro, on the podcast. John Gallegos. He says, how do you like an alternative asset management basket? I don't know, maybe just in general. Like, sometimes we don't like to make recommendations, but just thought on that sector in general.
Yeah, I've got an alternative asset management basket in my portfolio.
There we go.
So
right.
Yeah, that would be a pro.
Okay, here's what I think is, maybe I don't think any of us are close followers of the company, but I think it can be a good broader question to ask. So he says, this is Teja, I think that's how you pronounce it. Thoughts on PBR, which is Petrobras, not the beer. Nationalization risk seems low and is at 45% of free cash flow as dividends is hard to pass up. So I'm thinking he's saying it's at a 45% free cash flow yield. Okay, this is the Brazilian oil company. We don't have to talk about the Brazilian oil company, but maybe thoughts on international investing in general, emerging markets in general, like at achievement of price. Some of these seem to make sense to me, but man, I they're incredibly risky. And I don't know, John, do you ever stray into that bucket at all?
Not much, but if you look at oil and gas in general, in my opinion, the majors in the US are attractively valued and the majors outside of the US are trading at half the multiples the majors in the US are. And so you could argue that they're outside of the US extremely attractively valued. It's an argument. I think at a high level, I mainly focus on the US, so I'll talk about the US, but at a high level, we underinvested in oil and gas, drilling new wells for the last 10 years or so. And demand, I think, is going to hold stable or grow. Especially in certain parts of the world, demand's going to grow, and demand's going to be around for a long time. These are all my theses, my hypothesis, my premise. And so, I think maybe prices stay in a $60 to $100 range. I know that's a large range, but somewhere in that range. And at 60, these companies are still highly profitable. And all they care about these days is not drilling, but just returning the cash to shareholders. And so you get these massive shareholder yields. And the yields are even bigger outside of the US.
Or making huge acquisitions.
That's right. Since they're not drilling.
Yeah, both. Yeah,
they're
both
going
those
to grow.
two.
They're going to grow by buying proven reserves through acquisition.
Yeah, those
now,
two,
I'll say there's one company that knows how to drill for oil organically. They know how to find it, and that's EOG. This is not, investment advice, but EOG, what separates EOG from everyone else is that they do it organically. They know how to grow organically. They have 10 plus years of inventory, easy. They're in the Permian, which is, everyone in the US invests through a Permian lens. And we've been seeing consolidation in the US with 3 announced deals so far. Exxon announced a deal, Chevron announced a deal. I think there was a third, but EOG is kind of big. I don't know if it's 50 or 60 billion in market cap. I can't remember exactly. So it would be a big chunk for someone to pay, but that's a unique asset because they do know how to find and drill for oil economically. And while everyone else has been growing through acquisitions, they're doing it organically.
Yeah, and there's a follow-up on Petrobras. I was wrong on the 45% free cash flow yield. It is a mandate to pay 45% of free cash flow out as a dividend, which is nice. You get a little bit of a mitigation of the currency risk for at least U.S. investors, anyone, I guess, that's not in the Brazilian market. And I will say the big short guys, the actual big short guys, not Michael Burry, but the ones that worked at... what's it called? I forget their fund now, but two of the guys.
Steve Carell's fund.
Steve, that's how I think of it.
Steve Eisman's old fund, Front Point Partners or something.
Yeah, so two of the guys. They were on Value After Hours, and they did talk about Petrobras. So I would go maybe revisit that and the stuff they do. They know it way better than I think we do, but they are very bullish on it.
Statistically, extremely cheap.
Yeah,
statistically extremely cheap.
We have a teasing question from Travis Hoyam. John, what's your favorite cryptocurrency? But then he follows up with his actual question. Are there once not profitable SaaS companies that have turned the corner to profitability that interest you? And I think he's implying that the last couple of years you've been concerned over the unprofitability and valuation of these things.
Yeah. I own HubSpot. That one interests me a lot. I don't know much about it, but smarter people than me talk very highly about HubSpot. And so I own a little bit of HubSpot. I own Paycom, which was already profitable.
Was it Paycom that just got destroyed this quarter?
You want to know? Yeah. So I'm sorry. There's not many more. Travis, I appreciate the question. I think a lot of these are good business. I think, Snowflake, it's hard to argue it's not a good business. It's very hard to argue. Hard to argue that Zscaler and CrowdStrike are not good businesses. It's just not where I'm spending a lot of my time, but I do appreciate the question. But Ryan, this is the story I wanted to bring. It's not a macro story, but I think 2023 was the year compounders started to break. Let me give you what I mean. So I'm not talking about unprofitable. I'm talking about companies that investors gave the compounder title to. Okay. Dollar General broke. That thing was seen as invincible by a certain crowd. Adyen broke. I know that they're starting to recover, but broke. Dollar General and Adyen were selling off every single day for 2 weeks, every single day, and you said, and you're just wondering when it was going to stop. Paycom was one of two SaaS companies, I think, given that compounder status, them and Viva, because they were soundly profitable and free cash flow generative. Paycom broke. NextEra Energy. This was a utility that historically traded at 30 times earnings, broke. I think that's the story of the year. I think 2023 is the year compounders started to break. Paycom is one example, and I think that continues into 2024.
And the one thing I'll add there is when sometimes you look at a business and you love it. You absolutely love what the business is doing. You think it's going to be a bigger business in the future in terms of like customers, revenue, whatever you want to call it. And you compromise on price. This is a great, or compromise on multiple. This is a great example of, if you love those businesses, it might not come this year, it might not come the next year, it might not come for the next 5 years, but you will get it at an attractive valuation eventually. I can't, other than maybe Costco, I can't think of any business that has perpetually traded at kind of a ludicrous multiple without ever coming back down. And maybe Costco has.
Well, Costco's, I mean, Costco, I believe people turn, I'll pull up the chart, but I believe that's only been the last 5 or so years when people kind of fully came to consensus on that. But John, maybe, I don't know if you have I'll try to pull up the data.
But when I say break, I mean the stock price broke.
Yeah.
Falling 50, 60, 70% in a matter of weeks. I'm not talking about the business model, the moat. And that is the point though, Ryan. Like, you can wait. And no company is invincible. And valuation is going to come for every company at some point in time, in my opinion. Y'all know Illumina? Have y'all looked at this thing?
I've seen a lot of people talk about it. I don't really know it.
Not closely, but yeah, I just know the general overview.
10-year low. Trading at the same price it did in 2013. This is a company that has a technology for gene sequencing. I don't know much about it either, but it may, and this is not a statement on COVID vaccines, but it was impressive how quickly we were able to develop COVID vaccines. Well, that would not have been able to happen without Illumina's technology. Just plain and simple. This is not a statement on whether you're pro or negative vaccine. The technology allowed it to be developed as quickly as it was. That seems like a unique asset. Stock is down at 2013 levels.
Yeah. And yeah, it seems like from what I've read, and again, not an expert on it, but people that are experts say that it's sort of a monopoly. It would be hard to disrupt. And yeah, they got an activist in there. I think Icon's in there, and it's been super messy. I believe they made a bad acquisition that they're trying to break off again, or force them to break out. They're being forced
to. They made an acquisition after being told they shouldn't, and they closed on it anyway, and now they're being forced to divest it.
I think what's the most interesting part here is, okay, you can love Illumina. The narrative on it is fantastic for 10 years. And then you can say, okay, I'm going to wait for the right price, but the right price is only going to show up when things look messy. So I think you have to be prepared. Like, okay, maybe you have high conviction on Dollar General. Maybe you have high conviction on Adyen. Maybe you have high conviction on Illumina. Like, it's not going to feel as it's not gonna feel as good, but you have to trust the work you did in the past and say, like, look, the price does drive narrative a lot of the time. I mean, you could probably see people talking about that with C Limited. That's another compounder that seems to have broke, but that's more of a 2-year journey.
Yeah.
It is funny how you think like, you know what? If this valuation got cut in half, I'd buy it. And then it's like valuation gets cut in half. You're like, yeah, the thesis is broken.
but yeah, you always have to ask, okay, why would the valuation get cut in half? It's because a lot of people stop believing. And you have, that's what makes it hard. That's what makes it hard. Okay,
to answer kind of Travis's question a little more, there are some companies that come to mind for me. I think Monday.com is kind of one where they've now turned the corner towards profitability, and they've continued to grow kind of even through this SaaS-mageddon. But a lot of the ones where like profitability was visible and you had the sense that they could do that feels like they never really got as cheap as I would have preferred. Like it seems like analysts kind of knew like, okay, profitability is there. It's just a matter of choice or time.
Yeah. Just because it's down 50% does not make it cheap. Anything else on that, guys? Because I think with John here as a guest, that's someone who interviews, talks with all these. I think I have a good topic that could be, I don't know, maybe something that you could ask on the J Rowe show. There was this, it was like a meme joke tweet about using alternative data. I don't need to read through the whole thing, but it's like asking what alternative data even is. Like, do other funds have access to it? Like, what makes it alternative? Kind of like if everyone has it, is there actually an edge there? They're kind of poking fun at it. So I guess we've talked about that before. We're not really we don't have the budget for alternative data. So we kind of just get snippets if people post stuff online or share it around. But I mean, John, I don't know. What are your thoughts on that? Because the way I look at it is if every single person is subscribing to one of these things, then it can't, by definition, it's not going to be worth it. And if you kind of look at a month data going into earnings season, I mean, it feels like it's just way too much, maybe not way too much work, but the juice isn't really worth the squeeze. But again, curious your thoughts on this type of stuff.
I think that information, I think if you want to outperform the market, you have to have an edge. And I think an information edge is the hardest type of edge to come across. It's possible because all information is available to all investors at the same time, right? Publicly available information. But it's possible to have an information edge if you do what you mentioned the Big Short guys did. No one else was very few people, maybe you could count them on your hand, was going mortgage by mortgage by mortgage by mortgage inside of these collateralized debt obligations. That was a clear information edge because they were willing to work harder, dig deeper. So, but I think an information edge is harder and harder to get these days. The second type of edge is an analytical edge. What are you doing with that information? I suppose there are some people, some firms that are better at interpreting alternative data, that are better at incorporating alternative data into their overall framework and process. So I think even though it's possible that everyone has access to the data, it's how you interpret it that could possibly give you an edge. So, maybe it's worth it for some firms.
Yeah.
It feels like whenever something goes down, like between quarterly reports and it's kind of like on its own, my instant thought is like someone's got alternative data. Like someone's
or they're interpreting it as bearish. But what's interesting, and I think this is a fun exercise for anyone to do, anyone can do this, is whenever I read an earnings release, I try to, sometimes I'll look at you catch the stock reaction or something like that, but you read the earnings release and then you say, okay, do you think the stock's going to be up or down? And you can do this without I'm sure John is in this boat too of you're not, if you're not tracking exactly what the earnings per share revenue estimate is, and you say, okay, you look at this earnings release kind of your own internal expectations. Was there any positive surprise or negative surprise? And you go, okay, do I think the stock's going to be up or down after hours or up or down tomorrow? My track record is coin flip. So I have no idea what's going to happen. So I think that for the alternative data, I think you can get it. But the concern with me is like, okay, how do you interpret that? As you mentioned, John.
I also always think like, there's those funds that pay for satellites to track like inventory in the yard or like how many people are pulling up to the parking lot. And I just think like, if someone showed me for that quarter how many cars were in the parking lot versus a year ago. How many cars were in the parking lot that quarter. Long term, I have no idea what that's going to mean. It doesn't like maybe if you're just trading for that quarter, like, yeah, I'm sure you'll get some edge there if you're the one with the satellites. But if there's a little less cars in the Costco parking lot, I have no idea what that's going to mean for the stock 5 years down the road.
Yeah.
Which is
that's a great point as well.
So I have so many thoughts swirling around in my head right now. So yesterday I was talking to a top 10, I think, best known hedge fund manager in the US on the phone. And I didn't ask him if I could mention his name, so I'm not going to mention the name. But so at one point in time in the conversation, and it was to try to get him onto the show. That's why we were talking. And at one point in time in the conversation, he talked about how doing things the way that he did them required high velocity, is how he put it. And it required maniacal focus on markets, business, and investing. Maniacal focus, right? And so he would go through all of these things that he would do. One exercise he does is he asks himself if he were to build up the portfolio from scratch every week, would the portfolio look the exact same way as it currently does, in the same size? Every week he asks himself that. Doesn't mean he's restarting his portfolio every week, but he's re-underwriting the thesis in his head every single week for every single position in his portfolio. Every single position. And he's connecting all of these different data points. It's not just fundamental data, right? He's looking at liquidity data, especially on the short side. He's looking at factor exposure, which is such a huge risk in the short term. He's looking at alternative data. He's looking at macro data points. He's looking at fundamental data points, valuation data points. He's got models built on every company in the portfolio. And it's constantly connecting the dots for all of these things every day and every week. And he's maniacally focused on his screens and on his names and on his watch list. And, hearing that made me think about how relative to that, I'm a pretty one-dimensional investor. I'm really good, like no bullshit. I'm really good at, I think, understanding business models, understanding industry dynamics, understanding competitive advantages, and not just sources of competitive advantage, but having some sense of the durability and sustainability and trajectory of those moats. I think I'm really good at accounting and financial statement analysis. I think I'm really good at valuation. The fundamentals, right? The fundamentals of stock picking. I never think about liquidity because I'm not managing a short portfolio, a short book. I don't think about factor exposure as much as I should, but I'm starting to incorporate it in the last 12 months.
Maybe I'd care more about liquidity if I had more money.
Yeah.
Then it might become a problem. But,
I am starting to think a lot more about factor exposure, but I'm definitely not, an expert at it. Alternative data points, like you said, Brett, when I get access to them, when I see them, I try to think about it and I try to connect those dots, but I'm not doing it day in and day out like he is. If you're really managing a long short book and understanding the math behind gross versus net, how to leverage up a portfolio and manage towards volatility and beta exposure and all of these things, I'm very one-dimensional when it comes to that. And that's okay. For what I do, I beat the market. I enjoy doing it. I learn. But then there's levels to everything in life. And just hearing this guy, I was like, oh my God, I am such a beginner. And I've been doing it for 25 years. I'm just so much more one-dimensional than some of these just true masters. And
question for you. Question for you. Do you care about some of those things? Not that yes, if you're managing a fund, I think you definitely should care about some of those things, but for your own PA, your own personal account, do you care about the liquidity? Do you care about the factor
exposure, all this stuff?
Exposure.
I think it comes down to personality, and emotional constitution, right? So, my personality, my emotional constitution, the way I like to do things is I like to find 1 or 2 or 3 new ideas a year. Like very, very sloth-like, to use a Buffett phrase, right? That's the speed. That's the velocity I enjoy working at. There are people who that's just too slow and boring for them, and their brains are too freaking smart. There's too much going on. There's too much synapses firing too quickly. Look, Druckenmiller, right? 30% annualized. None of us can do what he does. His synapses are firing so much faster than ours are. He's connecting dots from all over the world and all over these data sets instantaneously. It's like, Buffett says Munger has the fastest 30-second mind in the world. That may be true. Druckenmiller's up there too. I don't know the man, but you look at how he thinks and how he acts and how he trades and how he talks. You got to imagine he's got one of the fastest 30-second minds in the world. I don't have that. And I'm just a much slower mover. So no, Ryan, I'm perfectly happy doing it my way. Doesn't mean I don't admire the crap out of someone doing it the other way, though.
Yeah, and for anyone that wants to listen to Druckenmiller, he did talk pretty openly on a lot of stuff in an interview with Paul Tudor Jones recently. If you search that, you'll find it. I will say another thing that this reminds me of is when maybe I like to throw out, if I'm kind of interested in something, throw out a couple of bullet points on Twitter and then just say, okay, where am I wrong here? And then I always get a lot of responses, or some people, maybe not always, but sometimes you get a response and it says, oh, well, next quarter is going to be terrible for blank, blank, blank. And I'm like, oh yeah, they could be right. But I don't really, it's like the time horizon mismatch can kind of get people to debate a lot of things. And in reality, you might agree with them, but you just might not care, because if you're not trying to trade in and out of this thing,
that's why both sides can be, the long and the short can be right. Absolutely. Yeah. The long and the short can be right depending on time frame.
I don't know. It's funny, and it's kind of different between us and the fund versus like my personal account, because you don't have the consistent money coming in, so you have to care more about what happens in the short term because you have to report that. But in the personal account, people will lay out some of these reasons why something might get destroyed in the next quarter, and I kind of think like, yeah, that's a really good point, but it doesn't really matter to me. Like it doesn't affect what I believe this business can do over the long run. But we do have a ton of questions here. Do we want to get to any of these?
Yeah. Do we have any
2 minutes left?
What did you see in the others from?
Tasia said a couple, and then there was also there was a question from Jay Weezen Snow. I'm sorry if I'm getting that wrong, but it says J-Row ! What's good, fellas joining late? Have you shared your thoughts on the Nelnet earnings from last week?
I think we did that next week, maybe.
Yeah.
Did we talk?
I thought we talked about it last week.
What company?
Did we?
Hear.
Nelnet. It's a Jim Gillies.
Yeah, no, I know. Okay. I thought he was asking me about Nelnet. I know y'all are in it. I know Jim Gillies loves it. Yeah, I know it.
It's a little bit of a
why don't we
boring quarter.
I think we could talk about it. Yeah, it's always boring, but we maybe talk about it next week. Actually, maybe I don't think we talked about it last week. There were so many other earnings, but
we got 1 minute, so I'm gonna ask one more question to both of you guys. 13F season, probably otherwise known as confirmation bias season. Is there any 13Fs?
Love me some good confirmation bias. Yeah.
Yes. Yeah. Are there any 13Fs that you follow consistently and care about?
Absolutely. I mean, I look at Berkshire's, I'm not going to lie, but I tend to look at concentrated managers. You know what I mean? Like,
yeah.
So Klarman one time said that Steve Mandel was the best stock picker of his generation. It's incredible compliment coming from Seth Klarman. Well, so Steve Mandel is on Datarama, and as y'all all know, but I don't even think he's managing the fund anymore. But regardless, he's got like 100 stocks in that fund, right? Like, I can't do anything with that. So like, if I'm looking at Steve Mandel's stuff and I have the most respect for the man in the world, he's one of the all-time best stock pickers. I'm only looking at, his top 10 holdings or the big moves the fund makes. You know what I mean? Like increases a position by 500% or 2000% or something like that. That's something that will catch my eye. But if you've got a new buy in a name that's a 0.03 position, it doesn't really do anything for me emotionally. And so, but if a concentrated manager makes a new buy or adds big that I respect and admire, that's absolutely catching my eye.
Yeah, I think what I like to look at is, okay, is it someone as a fund manager that probably follows a similar strategy that I'm looking for, which is like 10 to 15 companies, maybe even a little less, and basically buy and hold quality companies. One that comes to mind that I like to follow is Valley Forge, which if I look at their portfolio today, they could have international
six or 7 or 8 stocks or something, I think.
Yeah, I see. FICO, S&P, MasterCard, Moody's, Intuit, Visa, Aspen Technology, which I actually don't know what that is, and then ASML.
It's a software company.
Software company. They had zero activity last quarter, so I guess not interesting. And then I also look because I like Coupang a lot. I do own it in my personal account. I look if Druckenmiller still has it as his largest position. So I do look at that every quarter just for confirmation
Why not?
bias.
But man's a genius.
Yeah, if he's sold out of it, like, I don't know. I think it's interesting though on that company that he's been in it for so long. But yeah, I think that's really all I look at for 13Fs. I don't think Burries is very important. I don't think the ones that are like, either deep value or active traders are very valuable because it's on a 90-day lag. So you have to be looking for ones, I think, where the lag doesn't matter, because who knows what Burry's doing.
I look at Einhorn, religiously. I look at Cooperman religiously. I think the Valley Forge guys are great, girls. There's some. I look, I get excited for 13F season. I'm not gonna lie, but some are just more helpful to me than others.
Yep. All right. Well, I think that's going to do it, everyone. Went a couple minutes over, but thank you for everyone that joined the live chat. Appreciate all the questions. You can listen to the J Rowe Show on Apple, Spotify, wherever your podcast. Make sure if you do listen, give it a 5-star review. I will, as a disclosure, say that we are not financial advisors. Anything we say on this show is not formal advice or recommendation. Any of us may own, buy, or sell stocks on this podcast that we talked about. John, thank you again for joining.
Thank you all.
We'll see everyone. We'll see y'all next time.
Thanks, everybody.